Good afternoon. Last week, the market decided that artificial intelligence had just been made too cheap to be worth funding, and it sold the chip complex accordingly. Worst week for semiconductors in over a year. Worst month for chip funds since 2008. And then three inconvenient facts landed. The Chinese lab that caused the panic had to stop taking customers because it ran out of chips. The one company that makes the machines that make the chips raised its guidance by billions. And record money poured into the very funds everyone was dumping. That is not a demand collapse. That is a margin scare. Let's get into it. Here's the board, and the shape of it matters more than any single line. Friday, stocks fell on the chip rout. The S&P closed down about 1% at 7,458. The Nasdaq down 1.4%, but look at the third tile. The chip index fell 12.5% in a single week, its worst in more than 15 months, and it sits about 20% below its June peak. Meanwhile, the broad market lost 1%, and the fear gauge, at 18.77, never even broke 20. That gap is the entire story. This was a sector event wearing a market event's clothes, and today it is already unwinding. The S&P is up about 0.6, the Nasdaq up a full percent, and the chip index is up 2.4. Now the cross-currents. The 10-year Treasury yield sits at 4.55%, and it is bid on oil, not growth. Brent crude touched $90.79, the highest since June the 11th, then gave the entire move back. And here is the detail I want you to hold on to. Gold slipped below $4,000 to 9-month lows on a week with live war headlines. That only makes sense if the market is reading this oil move as inflationary, which revives the case for higher rates, and a higher rate is poison for an asset that pays you nothing. Bitcoin is quiet near 64,700. Hold that gold detail. It comes back. Now the signature segment. Consensus versus the read. First, and this is today's deep dive. The consensus is that a cheap Chinese model proves artificial intelligence is commoditizing, so the enormous spending on chips can never earn its money back. The tell says the opposite. 3 days after that release, the lab behind it, Moonshot, paused new subscriptions, because demand in the first 48 hours came close to the ceiling of the graphics processors it had available. Here's the mechanism the panic skipped. Giving a model away for free removes the cost of building it. It removes nothing from the cost of running it, and this one has trillions of parameters, so every single answer burns real hardware. Hand a powerful model to the whole planet, and you don't reduce demand for computing. You multiply the number of people who need some. The margin damage is real, but it lands on whoever sells intelligence by the token, not on whoever sells the machines. High conviction, and Frankie takes the whole thing apart in today's focus. Second read, consensus says the market is now pricing a genuine oil shock. The tell disagrees. Brent touched $90.79 and then erased the entire move on a single sentence from an Iranian spokesman about the possibility of talks. A market that is truly pricing damaged production capacity does not round trip on a quote. What it is pricing is interference with transit, and that distinction is the whole trade. Transit disruption is recoverable in days. Damage to actual facilities is recoverable in months. Goldman Sachs has said its $100 Brent scenario is back in play, so the asymmetry sits on the side nobody has paid for, medium-high conviction. Third read, consensus says Bitcoin is simply consolidating. The sharpest counterargument of the week came from a prominent technology investor, and it had nothing to do with crypto at all. His claim, and I'm labeling it a claim, is that the marginal speculative dollar now prefers prediction markets and equities, and the marginal unit of mining energy has a better-paying alternative use, serving artificial intelligence workloads. He attached a specific multiple to that energy comparison. It is his own estimate with no published source, so we are not repeating it, and the chief executive of Coinbase publicly rejected the mechanism on technical grounds. What is not in dispute is the tape. Bitcoin sat flat near 64,700 through a week in which an enormous amount of capital moved, and none of it came here. Medium conviction. Follow the money. The thread actually moving rates is the war. Treasury futures slipped as crude rose, and that is the signature of a supply shock, not a flight to safety. The 10-year at 4.55% is a statement about barrels, not about the economy. And this is where gold comes back, because it just went against us. gold slipped below $4,000 to 9-month lows. Our standing call was that gold holds its 4,000 zone as an inflation hedge into the oil shock. It is now on the wrong side of that, and we are saying so out loud rather than quietly rewording it. The mechanism beating us is legible. The oil spike revived expectations of higher rates, and a higher rate punishes an asset that pays you no yield. Per our own rule, we cite the level and the driver, never a contested percentage on gold. Underneath all of it. One more thread, a long-standing framework tracking global liquidity across dozens of financial systems, has liquidity momentum rolling over since the fourth quarter of last year. Not the level, the rate of change, which is what actually drives allocation. Two independent frameworks, one cyclical and one behavioral, landing in the same place in the same week, and neither is priced. Here is the fact that should have ended the argument before it started. 2 days before that sell-off, ASML reported, the Dutch company that makes the machines that make the most advanced chips on Earth, and effectively the only company on Earth that makes them. It raised its full-year sales guidance to 43 to 45 billion euros, up from 36 to 40. Several billion euros higher, and the second raise this year. It also said it is expanding capacity on its most advanced machines by about 30% for next year, with another 30% under investigation for the year after. Customers are signing longer agreements, extending visibility into 2027 and 2028. 2 days later, the same complex was sold as structurally impaired. Those two facts are only contradictory if you believe artificial intelligence is one single trade. It is not. And this is the week the market began splitting it apart. Word on sentiment and positioning, because it is the mirror image of the data. Our market and social sentiment monitoring shows commentary crowding almost entirely onto one narrative last week. China won, American models are hobbled, sell the complex. A prominent investor claimed the Chinese model handled security work that American models refused on safety grounds. That claim rests on a single developer's account, with no reproducible test and no published list. And we are reporting it strictly as a claim. What the consensus skipped is more interesting than what it said. Almost none of it sat with the capacity pause or with the guidance raise from the one true bottleneck in the industry. When positioning is this one-sided and the inconvenient details all cut the same way, the details usually win eventually. Here is the tell, the single most revealing data point of the day. In the very month that chip funds suffered their worst stretch since 2008, down more than 18%, those same funds took in record inflows, roughly $6 billion, the most ever recorded, price collapsing, money pouring in. Those two things do not happen together when the market genuinely believes demand is dying. They happen together when a crowd is dumping something and somebody considerably larger is quietly taking the other side. Prices carry emotion. Flows and order books carry commitments. When they disagree this violently, the commitment is the one carrying information. Sectors in play, 3 of them. First, semiconductors, and this is a split, not a crash. Equipment and leading-edge manufacturing are being actively validated by raised guidance and lengthening order books. The commodity memory tier is where a real price war lands first, and you can already see it. The memory fund is down almost 30% this month against the broad chip index's 18. Own the split. Do not just buy semis. Second, the actual casualty of cheap models is the model vendors themselves. If a good enough model prices about 40% below the frontier, the compressed margin belongs to whoever sells intelligence by the token, not the silicon, and not the companies using intelligence to build products. That is the most mispriced leg of the week. Third, crypto. A research report published back in January argues that value is migrating from the base blockchains up to the applications running on them, citing record application revenue of $3.8 billion last year across more than 70 protocols. That is a January figure, not today's tape, and we flag it as such. But the direction matters, because it implies the large tokens valued mostly on monetary premium carry a very different risk profile from the ones still valued on actual fees. On the radar, 6 things worth your attention. First, Alphabet reports Wednesday after the close. That is the test of whether artificial intelligence spending is actually converting into profit. Second, and bigger for this thesis, Intel reports Thursday. That is the cleanest available read on whether the chip derating is demand real or sentiment only. Third, July the 27th, when Kimi's model is released publicly and its claims finally become testable by people who don't work there. Fourth, the crypto market structure bill. 15 working days remain before the August 7th recess. Floor action is expected this week, and 3 separate fights are still unresolved. Fifth, whether Brent holds above or below 90, remembering that the reversal rests on one spokesman's sentence. And sixth, the Bab el-Mandeb Strait, because a second choke point on top of Hormuz would break the transit-only pricing outright. One more for the macro file. Andy Burnham was sworn in today as the United Kingdom's 59th Prime Minister, its 7th in a decade, promising a new economic model. Gilts and sterling are where that gets priced if it is wrong. Scorecard, where we grade the dated calls, including the ones losing. 3 new calls on the record today. 1 margin scare not demand top. Over the next month, semiconductor equipment and leading-edge manufacturing hold up better on a relative basis than the commodity memory tier, and the complex does not make sustained lower lows on demand news. That is falsified if order books or spending guidance actually get cut. High conviction. 2. Compute scarcity. Not glut. Within 90 days, at least one more frontier-level lab publicly rate limits, wait lists, or raises prices citing capacity. Falsified if instead we get serving gluts and broad price cuts. 3. Transit not production. Brent does not sustainably settle above $100 absent confirmed damage to production or export facilities as distinct from interference with shipping. And now the carry forward, including the loss. Our gold call. That gold holds its $4,000 zone as an inflation hedge is on the wrong side today. Gold slipped below 4,000. The formal falsifier was a decisive break below 3,800, so it is not dead yet, but it is losing, and we are flagging it rather than burying it. On the other side, our call that the chip rout is a repricing rather than a demand crash is tracking and got stronger. The guidance raise, the capacity pause, the record inflows. And today's bounce all cut in favor. The close, the most expensive mistake in a repricing is assuming that you and the market are answering the same question. Last week the market asked, what is intelligence worth? And the answer came back, less than we thought. But an enormous number of people heard something completely different. They heard, the world needs less of it. Those are not the same sentence, and the entire gap between them is where the money is. So here is the one to sit with. If the fear is that artificial intelligence is getting too cheap, why did the only company that can physically make it possible just raise its guidance by billions? And why did the cheap challenger have to close the door? Today's focus goes deep on exactly that. The asymmetric signal. 1 contrarian read a day. Subscribe.